Hello there and welcome back to Inside Options. We're talking today about using derivatives to make yourself a bit of a profit when markets fall. James, it sounds like a Machiavellian statement, but I mean it is pretty much what we're talking about.
Yeah.
And we now need to talk a little bit about risk. How do you hedge when hedging one's portfolio as either a retail investor or a fund manager?
So that's an important point to note here, is that just about everyone watching the show, you're going to be exposed to equities in some way. Through your pension fund, if your company's got a pension fund, or if you've got some savings, a unit trust, all sorts of things, you're going to be somehow invested in the stock market. So
Yes.
what you're doing by sort of shorting the Aussie in a time of sort of market concern, you're taking some of that risk off the table. You're sort of hedging some of that fall in price. Now, the great thing about that is that after there's a collapse, prices are really great. And over the long term, if you buy in at a low point, your returns really, really look good. I mean, that's the essence of value investing.
Exactly, and we hear that people have been buying in just literally on the stock market.
Even recently at the moment.
Yes.
So there are some stocks that, according to some of the experts and the guys you have on Stockwatch and stuff, they're saying some of them are looking quite cheap, and compared to the historical averages, some of them really are.
But then holding them for the longer term,
Exactly.
right?
So you've got to hold them for the long term. Now, a fascinating quote I sort of found in this Franco Bussetti book is by Warren Buffett. So what is value investing? Value investors are realists who buy shares from pessimists and sell them to optimists. So before you can buy the shares, you need to find some pessimists. Before you can sell the shares, you need to find some optimists. So generally the market goes around, as Benjamin Graham said, there's this crazy guy called Mr. Market who's sort of manic depressive, and he swings from being really, really happy, being really down in the dumps, and somewhere along the way you can buy stuff from him very cheaply and sell it back to him very expensively. And that's
and that's why they say markets are driven by sentiment.
Exactly, they really are. There's a lot of sentiment that comes into it. Then after that sort of initial crash has happened, people step in, do the fundamental analysis, and then you can buy the shares. Problem is, I know sort of quite a lot of my friends, we're all like, wow, why didn't we buy in March 2009? Did you have any money in March 2009? I don't know many people who did. They were just sort of bills to pay, tricky time of year, all sorts of issues. So you didn't have the money to take advantage of that opportunity. So if you did have the cash at the right time, you could really take advantage and have a great portfolio set up for the long term.
Right.
So that's
you're
part of what this is.
Perhaps now is a good time
perhaps now
to start
you can think
that?
about having some cash somewhere that you can invest when prices do get lower, if prices do get lower. I mean, who knows? The market conditions around the world at the moment are incredibly uncertain. So one way you can manage that uncertainty is taking some risk off the table by going and selling a few Aussies. The great thing about Aussies is, as a proxy hedge, fund managers use them a lot, even though it's not exactly like their portfolio, because it is very liquid. So I mean, yesterday, as of today, so I think that was the 16th of August, we had about 40,000 contracts trade in the Aussie. So that's a value of about 10 billion rand of turnover. So there's 40,000 contracts being passed through the market and 10 billion rand of turnover. And the total open interest at the moment of those 218,000 contracts works it out to be about 58 billion rand. So this is a very, very liquid, low-cost way of taking on risk or taking risk off the table, depending on your view of the market.
And
it really enables you, in volatile times, it really enables you, without going and liquidating your whole share portfolio and watching it gap up, you'll have a cash cost if the market moves against what you've done. You'll have to pay in if the market rallies up and you've gone short the Aussie and the market pops 1,000 points the other day, shorts get squeezed. And
you really do need to
watch what you're doing. But it is a way of managing some risk, taking some risk off the table, or adding on risk if you think the market conditions justify it.
James, we have 2 minutes. There are also some seasonal phenomena at stake here which might help guide people as to when to get in and when to get out.
So I was looking at this fascinating thing with Franco Bussetti, this book, The Effective Investor. I was actually feeling quite guilty because I mentioned it on the show and I realized I haven't read nearly enough of it. It's got some brilliant stuff in it. I mean, the one thing we're looking at here is some of the seasonal effects of the Aussie. The fascinating thing is that old saying in the markets is sell in May and go away. Now in South Africa, the data tends to confirm this. So since 1960 to 2008, if we look at the Aussie, there are two clear halves to the year. The average returns for the 6-month period, so over the whole 6 months, from December to May have been 9.9%.
Right.
Now average returns from June to November have been 3.8%.
Well, that's clear.
So it's a very clear difference. I mean, 9.9 to 3.8. This is very statistically significant, and it's persisted for 48 years. So this is a very, very interesting sort of pattern. It means that your annual returns in the market, 72.4% of it comes from the December to May period. Then generally less of it comes, the other sort of 26%, 27% comes in that later period of June to November. So that's the really one. The other seasonal pattern, which I find fascinating, is Monday being the worst day of the week for the Aussie.
And Wednesday being the best.
And Wednesday generally being the best performing day. So that's pretty interesting. And I mean, what do you think causes that? I mean, are all the fund managers sort of hungover?
Blue Monday.
Have a Blue Monday phenomenon? I mean, that's what they call it, the Blue Monday phenomenon.
Yeah.
Are they just talking themselves into circles around the briar saying, country's going to the dogs again, it's terrible, gold miners can't make money, it's awful, look at the politicians.
But they're perked up during the middle of the week?
Perks up during the middle of the week. By Wednesday, the profits come rolling back in.
Sentiment.
The other one is the end of the month phenomenon. 25th to the 5th, generally the strongest period of the month.
People get paid.
People get paid. Debit orders go into bank accounts, passes on to the fund manager, they increase their purchases. Interesting thing is that's been getting earlier and earlier, but as fund managers start using Aussies to manage incoming cash flows. I mean, that is another way of doing it.
Very interesting. James, we've run out of time.
Out of time. But
we'll catch up
please
next
do
week
look into,
again.
guys out there, please do look into trading the Aussie, understanding how you can hedge some of the risk in your portfolio, manage your risk out there in these sort of turbulent times.
And watch those markets very carefully.
Absolutely.
All right. James Boardman, thanks very much for joining us. See you next time on Inside Options.
Inside Options was brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.